Hey, what's going on, guys? Welcome back to another video. Today, I'm gonna teach y'all how to do the ICT Silver Bullet strategy. Yesterday, I made a video showing you guys how to enter on the ICT Silver Bullet strategy, but I didn't go in depth for the new traders who don't understand what it means. And I kind of went advanced on it yesterday, but today I'm gonna keep it basic and legitimately teach you guys how and what the ICT Silver Bullet means and how to trade it. So in this video, I'm gonna teach you guys I'm gonna show you guys the example on screen and then show you the candles afterwards. So I'm gonna go through in order what liquidity means, market structure shift means, and fair value gap. So let's get right into it. In order, we're gonna look for something called liquidity, market structure shift, and a fair value gap. These are all in order. Okay, so starting off with liquidity, I'm gonna grab my brush tool so I can show you guys. Liquidity simply means the highest point of a chart and the lowest point of a chart. Okay, so every chart has a high and a low. Okay, a high and a low, just like stairs. Every point on a chart has liquidity lying. But for the ICT Silver Bullet, we're going to be looking for the absolute liquidity where price peaked either buy side or sell side. Buy side simply means the top, sell side means the bottom. So buy side top, sell side bottom. We're going to ignore all the noise in between because this is where we trade in between. Okay? So simply, liquidity lies on the top, lies on the bottom, lies on the bottom, lies on the top. So in every bearish market, liquidity is on the top, liquidity is on the bottom. Every bullish market, liquidity is on the bottom, liquidity is on the top. It's just reversed. Now, a market structure shift happens usually after liquidity has been taken out. So liquidity getting taken out looks something like this. I'm going to draw it out for you guys. That is how liquidity getting taken out looks like. Okay? Because remember, in a bearish, for example, a bearish market or a bearish bias, the liquidity lies on top. But what happened? After price coming down, the market went up and broke above the old liquidity up here. It broke above this, making it a new high. So this is a new high and this is a new high, making it a bullish momentum. Starting from here, it became bullish momentum. This is now liquidity, and this is now liquidity up here. Or was, sorry, this was liquidity, but this bottom here is now the new liquidity, and up here is now the new liquidity. Okay? Delete this. This got broken. This got raided. This is the new liquidity, and this is the new liquidity. A market structure shift happens after liquidity gets raided or taken out. When a new high forms, that's when we look for a market structure shift. A market structure shift simply tells us that the market is now reversing its direction. So over here, this is called a market structure. And because this candle, for example, there would be a candle here, failed to make a higher high than this, it went down and broke under this market structure, this low. It broke under this. indicating to us that market is now reversing. There's a reversal in the market. That is the simplest way I could put it. And I'll show you guys on the candles in a second. But that is what a market structure shift is. Now, after a market structure shift happens, you're going to look for a fair value gap. We are already on the last step. This is how easy it is, guys. It's super easy. Okay. A fair value gap happens. A fair value gap happens right before the market structure shift, or a little bit after it happens, after the market structure shift. If there is no fair value gap before the market structure shift, you're going to look for one after the market structure shift. A fair value gap would be highlighted with a gray box until price comes back into it, and then all the way down to its new liquidity down here that we marked out earlier. Like I said, this was the new sell side liquidity. This is the new buy side liquidity. And this is our target down here. Our target will be the opposing liquidity from the top to the bottom. It's as simple as that. Okay, so this is how the market moves every morning, guys. Every morning. When there's news morning. Usually the market does not do this. It fluctuates, consolidates, does different stuff. So I don't trade news days. I only trade days such as Tuesdays and Thursdays. Tuesdays to Thursdays are the best days to trade, in my opinion. They worked best for me. The most volatility are there, the most movement. Everyone's working, Wall Street's up, everything's good and running. Mondays are the worst days for me personally to trade. I've never won a single Monday in my life, and I've never won a single Friday in my life. All my losses happen on Monday and Friday, so I stopped trading Monday and Friday. And I've seen consistent results when I traded Tuesday, Wednesday, and Thursday. Okay? That's basically everything. This is how you look at the markets at from 9:30 a.m. to 11 a.m. every single day. Or whenever you're trading. Not every single day, but whenever you're trading. Now, the main time frames you're going to use for this strategy is the 5-minute and the 1-minute. Sometimes you will be using the hourly candle, or the hourly time frame, if the market isn't showing signs of high absolute liquidity. If you're unsure and there's too many liquidity spots, use the hourly and mark out the 9 a.m. candle, top and bottom. In this case, in this scenario, we can mark out the top, we can mark out the high, we can mark out the low already. Okay? So, what we're going to do right now is go on the candlestick chart. I'm going to show you guys exactly how everything would go into play on the candlestick chart. Okay? So, we're going to go to the 5 minutes. We're going to mark out liquidity before 9:30 in the morning. Okay? So over here, the highest point right before 9:30 is this up here. Not this, but this one, because it made a recent swing low. The reason why we chose this liquidity point and not this or not this is because this made a new low. Before the swing high, after the swing high, there was a swing low. That validates this as the new high. Okay, that's a lower high. Liquidity was lying around there. So we're going to mark this out. Press this and mark it out all the way to 11 a.m. We're going to grab the trend line again and mark out the bottom of this candlestick all the way to 11 a.m. We're going to drop down now to the 1 minute time frame and show you guys. Sorry, this is weird. I'm going to fix it and put it right here, okay? This is where liquidity was lying, down here. Not here, because this is where we're continuing. This is where it's about to turn 9:30 in a little bit. But anyways. Next, we are going to grab our vertical line and mark out 9:30 and 11 a.m. I'm going to hit the replay button in a second, and I'm going to simulate as if I entered, because I entered this was yesterday, or sorry, this was today. I'm going to simulate as if I entered in a little bit using these buy and sell buttons down here. Okay, so let's click play and see what happens right here. So before 9:30, liquidity, as we spoke about before, got ran out. Okay, liquidity was ran out before 9:30. It could happen after 9:30. It could happen at 10 a.m. even. It doesn't have to be before 9:30. Usually it's better if it happens around 9:50. That's where I'd be most confident to enter. But this is fine as well. So it runs out liquidity. We're going to continue playing it, and we're going to look for a market structure shift as we discussed earlier. We're going to look for a market structure shift right here. Okay. There was no shift, but now we know that we now have a market structure, a structure point. So a market structure point happens after liquidity gets taken out, and then makes a reversal, a slight reversal, all right, like a little structure, a little base up top, showing us that this is the point that price has to break through for it to reverse and go bullish. Okay, so this is the indicator for us. Okay, we're gonna wait for this line to get broken. The actual candle has to close above this line. The full body candle has to close above it. If it's wicked above it, it does not count. Again, a wick is the line that's under the actual candlesticks. That's called a wick. If it wicks above it, it doesn't count. But if it closes above it, if a blue candle fully closes, green, blue, whatever candle is your bullish candle, whatever color it is, closes above, that's called a market structure shift. So we're going to look for that right now. Price continues going down, and boom, there we go. Right over here, we have a market structure shift because this candle closed above it at 9:31 a.m. Meaning now, our last step before we enter is to look for a fair value gap. Now, a fair value gap, as we discussed, happens before the market structure shift or after it. Right here, we see four fair value gaps, 4 of them. But we're going to use the most recent one that caused the market structure shift. In this case, it's this one right here that we discussed, which is 9:31 a.m. We're going to grab our rectangle tool and mark it out from the top of the first candle to the bottom of the third candle. Make sure you include the wick as well. So let me zoom in for you guys. The top of the first candle to the bottom of the third candle. That's how you mark out fair value gaps. If it's in a bearish position, it's the bottom of the first candle and top of the third candle. A fair value gap means that there's a gap in the market, a gap in between two candles, showing us that price was never traded between there. The institutions, the people, no one placed an order between those 3 candles. Okay, so it was just a running smooth long candle with volatility and volume inside of it that just continued running without any buy orders or sell orders. Okay. With that being said, we're going to wait till price, as we discussed, to hit the fair value gap box so it can continue going up. We're going to wait and see what happens right here. Boom. Okay. So it hit exactly this candle, went down and hit this box and instantly rejected all the way up. It made two candles to the upside, rejecting this box. Okay? That's a strong sign telling us that we should enter now. So, because the candles went a little bit too fast, I have it on 3 times, we had to have entered as soon as this candle touched the box. As soon as it touched the tip of this box, we enter our trade. So I'm going to get my long position, and I'm going to put my entry here. And our profit target will always be the opposing liquidity that we first marked out. That is going to be our target. Okay? Let me just mark this out as liquidity. Okay, and our stop loss, I'd like to put it usually under the new liquidity as we mentioned before. Remember, this was a new swing low. This was new liquidity. Okay? This is new liquidity down here. Even though this was the old one, this is the new one, and this is the old one. So you always go to the opposite old one and basically wait for your profits to take profit to get hit. Usually we look for, even ICT said this himself, we usually look for 10 to 15 handles if you can, minimum. If you cannot, or if you're not confident, if you don't see that the chart is going to reach 10 to 15 handles, close the trade. Close the trade or don't even trade at all. Okay? Right here, we see a huge move up, and we anticipate it. We know what's going to happen for sure. Not because it's replay mode, but because if this was real time, the confluences are really, really strong, telling us there's a reversal in the market. Okay? So, that said, let's click play and see what happens. So, as you can see over here, it gave people a second opportunity to enter into the market. You see this? You see this blue candle over here? This is blocking it, but you see this blue candle over here? It gave people a second opportunity to enter. So let's click buy here. Let's say we entered on this candle. Let's say we were late. Even if we were late, this would have still counted. This would have still counted and had us take profit. Okay, so you see it's playing around the fair value gap, playing around. We're still in between the time frames from 9:30 to 11, and there we go. Our profit got hit. And it continued running up, as you guys can see. We could let it play, continued running all the way up. Then it came back down. Yeah, simple as that. Like, let's say we close our profit up here, we would have made $1. That's just trading view being trading view, but that is exactly how you play out the ICT Silver Bullet. It's so simple, guys. It's so simple. And yeah, that's all that's all it basically is. It's 3 confluences you guys want to look for. No daily bias needed. And again, ICT said this himself, you can quit your job in 90 days. Guys, I was just working a job not too long ago. I used the ICT since I started using the ICT Silver Bullet. I quit my job. I told my boss I quit. I'm gone because I want to do this full time, and it's been working for me. And now I just live off trading. I just do the ICT Silver Bullet every day, every morning, 3 days a week. And yeah, that's all for today. Thank you guys so much for watching. And if you guys want to see a full a full video about how trading works, what brokers mean, what pips, handles, liquidity, and a full beginner guide, just let me know down in the comments, or by just liking this video, and I would very much appreciate it. Anyways, thank you guys for watching. See you guys in the next video. Peace out.